There is something deeply paradoxical happening in the plumbing of global finance right now, and most people, even experienced investors, are not paying close enough attention to it. On one side of the equation, the United States Federal Reserve formally ended quantitative tightening on December 1st, 2025, after draining approximately $2.4 trillion from its balance sheet since June of 2022. On the other side, stablecoin supply has surged to a record $308 billion as of mid-February 2026, with Tether's USDT alone commanding nearly $184 billion and Circle's USDC sitting at roughly $73.5 billion. And right in the middle of these two monetary tectonic plates sits Bitcoin, which has fallen from its all-time high above $126,000 last October to approximately $69,000 today, a drawdown of nearly 45%, while spot Bitcoin ETFs have experienced $5.8 billion in net outflows over just the past 3 months. The question this raises is not simply about price. The question is about what happens when the world's most important central bank stops draining liquidity from the system at the exact same moment that the world's largest private dollar-denominated instruments are minting new supply at record pace. That intersection is what we are going to unpack today, because understanding it is the difference between navigating what comes next with clarity and being blindsided by it. Let us begin with the Federal Reserve's balance sheet, because this is where the entire monetary backdrop originates. As of February 11th, 2026, the Fed's total assets stood at approximately $6.62 trillion. Between the peak of its pandemic-era balance sheet and the formal end of quantitative tightening in late 2025, the Fed reduced its holdings of Treasury securities and agency mortgage-backed securities by roughly $2.4 trillion. A paper published by the Federal Reserve Board on February 2, 2026, decomposed this reduction into 3 components. 59% of the decline in the ratio of Fed securities holdings to nominal GDP was driven by active reductions, meaning deliberate decisions by the FOMC to allow maturing securities to roll off without reinvestment. 26% was attributable to inflation eroding the real value of those holdings, and the remaining 15% was driven by real GDP growth expanding the denominator. This is a critical distinction because it tells us that the Fed was much more aggressive in this tightening cycle than during the 2014 to 2019 normalization period, when passive factors like inflation and GDP growth accounted for more than half of the balance sheet's shrinkage relative to the economy. The policy posture was fundamentally different, shaped by the post-pandemic spike in inflation and an extremely tight labor market. Now, here is where things get genuinely interesting. On October 29, 2025, the Fed announced that beginning December 1st, quantitative tightening would officially cease. The balance sheet was frozen at approximately $6.5 trillion, and Treasury Secretary Scott Bessent stated publicly on February 8, 2026, that he would not expect the Fed to move quickly to shrink its balance sheet further. The Fed has also indicated that the roughly $16 billion per month in maturing mortgage-backed securities it still holds will now be reinvested into Treasury bills rather than rolling off. This means the Fed is no longer draining liquidity. It is holding steady and, in a technical sense, redirecting cash flows back into the shortest end of the government bond curve. For markets, this is a sea change. Quantitative tightening was the single largest headwind to dollar liquidity in the global financial system for 3 years. Its removal does not instantly flood the system with new money, but it eliminates the gravitational pull that was slowly extracting reserves from the banking system. This is where stablecoins enter the picture, and this is where the paradox crystallizes. As of February 14, 2026, the total stablecoin market capitalization reached $307.97 billion. Tether's USDT accounts for 59.7% of that figure at approximately $184 billion, though this number has actually declined slightly from over $187 billion in early January, a development that data provider Bein Crypto flagged as the first negative growth in USDT market cap in 2 years. Circle's USDC, by contrast, has been growing. Between February 5th and February 12th alone, Circle issued 8.4 billion new USDC tokens and redeemed 5.8 billion, a net increase of 2.6 billion tokens in a single week, pushing USDC's circulating supply to 73.1 billion. The divergence between USDT and USDC is not trivial. It tells a story about the composition of demand for dollar liquidity in crypto markets. USDT has historically been the dominant stablecoin for offshore trading, for retail participants in markets where direct dollar access is limited, and for settlement on the Tron network, which remains the primary low-fee settlement layer for Tether outside of Ethereum. USDC, on the other hand, has increasingly become the stablecoin of choice for institutional flows, DeFi protocols, and regulated payment applications. Circle's public listing on the New York Stock Exchange and its compliance with the Genius Act, which President Trump signed into law in July 2025, have positioned it as the regulated counterparty that traditional finance institutions prefer. Visa has confirmed the use of USDC for settlement. PayPal has expanded its own PUSD stablecoin into its merchant ecosystem. When USDC issuance is surging, even as USDT supply contracts, it suggests that institutional money is actively flowing into the stablecoin ecosystem, while retail or offshore demand is either flat or slightly receding. This is a structural rotation, not a contraction, and it matters enormously for understanding where liquidity is actually being directed. Now let us connect this back to Bitcoin and the ETF flows that sit at the center of this analysis. Since the launch of spot Bitcoin ETFs in January of 2024, cumulative net inflows into these products have reached approximately $54.7 billion. Total net assets across all U.S. spot Bitcoin ETFs are approximately $135 billion. BlackRock's iShares Bitcoin Trust leads with roughly $72 billion in assets under management, representing 53% of the market. Fidelity's FBTC holds approximately $33 billion. These are extraordinary numbers by any measure. The iShares Bitcoin Trust was the fastest ETF in history to reach $50 billion in assets, and it attracted $37.2 billion in net inflows in its first calendar year alone, making it the third largest ETF by fund flows in 2024 behind only the Vanguard and iShares S&P 500 index funds. But the recent picture tells a very different story. Over the past 3 months, the iShares Bitcoin Trust has experienced approximately $2.8 billion in net outflows. The broader category of spot Bitcoin ETFs has seen $5.8 billion in net outflows during that same period. On February 13th, U.S. spot Bitcoin ETFs bled $410 million in a single day as Bitcoin slipped below 66,000. And yet, as CNBC reported today, ETF analysts argue that this does not signal a capitulation event. Matt Hugin, the chief investment officer at Bitwise Asset Management, pointed out on the network's ETF Edge program that much of the selling pressure is not coming from long-term allocators or financial advisors. It is coming from hedge funds and short-term traders who use the most liquid ETFs as tactical instruments. Galaxy Digital CEO Mike Novogratz stated at CNBC's Digital Finance Forum last week that the crypto market's era of speculation may be ending, and that returns going forward will resemble those of a long-term investment holding rather than a vehicle for 10-to-1 leverage. This distinction between who is selling and who is holding is essential. If the aggregate cost basis for all spot Bitcoin ETF holders is estimated near $79,800, and Bitcoin is currently trading around $69,000, it means the average institutional ETF buyer is sitting on a roughly 13% unrealized loss. That is uncomfortable, but not catastrophic, and it explains why we are not seeing outflows that approach the scale of cumulative inflows. The money that entered these products through financial advisor allocations, pension consultants, and long-horizon institutional mandates is, by and large, staying put. The money leaving is faster, more tactical, and more sensitive to momentum. Here is where all three threads weave together into the paradox that defines this moment. The Federal Reserve has stopped draining liquidity from the financial system. Stablecoin issuance has reached record highs, with over $300 billion of dollar-denominated digital liquidity sitting on the sidelines or flowing through decentralized finance protocols. DeFi lending markets, according to Amber Data's institutional research, show total value locked near $58 billion with utilization rates of only 35 to 36%, meaning there is ample lending capacity that has not yet been deployed. and yet Bitcoin has lost nearly half its value from its peak. Gold, the traditional safe haven, is trading at all-time highs. The so-called digital gold thesis is being tested in real time. Will Rind, the founder of Granite Shares, said on CNBC this week that for supporters of the digital gold narrative, this divergence is deeply unsettling. When Bitcoin drops nearly 50% while gold sets record highs, it challenges the foundational investment thesis that drew many institutional allocators into the asset class. So what explains this disconnect? The answer lies in understanding that liquidity conditions and risk appetite are not the same thing. The end of quantitative tightening and the growth of stablecoin supply create the conditions for liquidity to flow into risk assets, but they do not guarantee that it will. The macro environment in early 2026 has been dominated by geopolitical uncertainty, including tariff escalation rhetoric from the Trump administration that triggered $875 million in crypto liquidations in a single day in January, as well as sticky inflation data and the ongoing adjustment of market expectations for Federal Reserve rate cuts. Core CPI did decline to 2.6% in January, which sparked a brief rally, but the broader trajectory remains uncertain. In this environment, the $308 billion in stablecoin supply functions as dry powder. It is capital that exists in a dollar-denominated, instantly deployable form, waiting for a catalyst to rotate into risk assets. But until that catalyst arrives, whether it is sustained ETF inflows above $200 million per day, a decisive break above 95,000 on Bitcoin, or a clear macroeconomic signal that liquidity remains parked. For anyone attempting to navigate this landscape as an investor or allocator, there are several practical considerations that deserve careful attention. First, the regulatory environment has changed fundamentally. The Genius Act, signed into law in July 2025, establishes federal licensing and supervision requirements for payment stablecoin issuers. It mandates one-to-one reserve backing, transparent disclosure, and audit requirements. The FDIC approved an application framework for stablecoin issuers in December 2025. This means that stablecoins are no longer operating in a regulatory gray zone in the United States. They are subject to federal oversight, and the distinction between regulated issuers like Circle and offshore issuers like Tether will increasingly shape how institutional capital interacts with these instruments. For investors in Europe, the Markets and Crypto Assets Regulation, known as MiCAR, imposes its own set of authorization and reserve requirements. Though the structural dominance of dollar-denominated stablecoins means that European regulatory frameworks have limited influence on where global stablecoin liquidity actually flows. Second, tax considerations vary significantly by jurisdiction and should be factored into any strategy involving stablecoins or Bitcoin ETFs. In the United States, spot Bitcoin ETFs are treated as grantor trusts for tax purposes, meaning gains and losses flow through to the investor and are taxed as capital gains. Short-term positions held for less than a year are taxed at ordinary income rates, which can exceed 37% at the highest federal bracket. Long-term positions held for more than a year benefit from lower capital gains, rates of 0, 15, or 20%, depending on income. In the United Kingdom, Bitcoin ETF gains fall under capital gains tax with an annual exempt amount that has been progressively reduced. In Canada, only 50% of capital gains are included in taxable income. In Russia, digital assets are taxed under the Digital Financial Assets Framework, adopted in recent years, with specific reporting requirements that vary by transaction type. The critical point is that moving between stablecoins and Bitcoin or between Bitcoin and fiat currency can create taxable events in every major jurisdiction, and the timing of those moves relative to holding periods materially affects net returns. Third, and perhaps most importantly, risk management in this environment requires understanding the structural dynamics rather than reacting to price alone. The fact that stablecoin supply is growing while Bitcoin is declining tells you that capital is not leaving the crypto ecosystem. It is repositioning. The fact that ETF outflows are concentrated among tactical traders while long-term holders maintain their positions tells you that the investor base is bifurcated, and the behavior of each segment has different implications for where price goes next. The fact that the Fed has ended quantitative tightening tells you that the single largest structural headwind to dollar liquidity has been removed, but it does not tell you when that liquidity will flow into any particular asset. For those who are considering or managing a Bitcoin position, the data suggests that this is a period of consolidation, not capitulation. The estimated aggregate cost basis of ETF holders near $80,000 creates a gravitational pull. If prices remain below that level for an extended period, you would expect to see larger institutional outflows as loss tolerance is tested. But if prices stabilize and macro conditions improve, that same cost basis acts as an anchor, because investors who bought at those levels have a strong incentive to hold and recover rather than realize losses. The practical strategy in such an environment is to size positions according to your loss tolerance, not according to your upside expectations. If you cannot withstand another 30% drawdown from current levels without being forced to sell, your position is too large relative to your risk capacity. Looking at what lies ahead, there are several indicators that serious market participants should track closely. First, watch stablecoin mint and burn ratios on a weekly basis. Sustained net minting of USDC in particular signals institutional capital formation and is a leading indicator of deployment into risk assets. The $2.6 billion net USDC increase in the week ending February 12th is a meaningful signal. Second, monitor Bitcoin ETF daily flows with attention, not just to the headline number, but to which funds are experiencing inflows and outflows. BlackRock and Fidelity absorbing capital, while smaller funds see outflows is a sign of flight to quality within the ETF ecosystem, which is constructive for market structure even if headline numbers appear negative. Third, pay attention to the Federal Reserve's reinvestment behavior. The shift from allowing MBS to roll off to reinvesting proceeds into Treasury bills is a subtle but significant change in the composition of short-term dollar liquidity. It increases the supply of the safest short-term assets in the world, which paradoxically can lower short-term rates and push capital toward higher-yielding alternatives, including crypto lending markets where utilization remains low and capacity remains ample. Fourth, the Treasury General Account balance, which the New York Fed estimates could peak around $1.025 trillion by late April 2026, will act as a temporary drain on bank reserves as the Treasury rebuilds its cash buffer following the debt ceiling resolution. Once that buffer is built and spending begins to draw it down, reserves will flow back into the banking system, adding to the liquidity tailwind. The stablecoin liquidity paradox is ultimately this: we have more dollar-denominated digital liquidity than at any point in history, existing alongside a central bank that has stopped tightening, inside a market that has just experienced one of its most significant corrections since the FTX collapse. The pieces for a recovery are in place. The $308 billion in stablecoins is not dead money. It is patient capital. The $55 billion in cumulative Bitcoin ETF inflows represents structural demand that has fundamentally changed how Bitcoin trades. The end of quantitative tightening removes the headwind that suppressed risk asset valuations for 3 years. But none of this operates on a predictable timeline, and anyone who tells you they know exactly when the rotation from stablecoins into Bitcoin will accelerate is either guessing or selling you something. What we can say with confidence is that the architecture of this market has changed in ways that were unimaginable even 2 years ago. Bitcoin now has a regulated, institutional-grade access layer through spot ETFs that attracted more capital in their first year than any other ETF category in history. Stablecoins now operate under federal supervision in the United States and comprehensive regulation in Europe. The Federal Reserve's balance sheet, after one of the most aggressive tightening campaigns in modern monetary history, has stabilized. The relationship between these three forces, central bank liquidity, private dollar issuance, and institutional crypto access, will define the next phase of this market. The investors who understand that relationship, who track the data rather than the narrative, who size their risk appropriately, and maintain the discipline to act when conditions align rather than when emotions compel them, are the ones who will be positioned to benefit when that $300 billion in stablecoin dry powder finally begins to move. And the data, if you know where to look and what it actually means, will tell you before the price does.